Newsroom.com, and Mayuresh Joshi, Head of Equity Research at William O'Neill, join in. Gentlemen, good afternoon to both of you. The first query that comes in this afternoon is from Mr. Vipul Shah, who has written to us from Baroda. He wants to know if Tata Power would be a good buy at current levels. So, Mayuresh, first to you, because, power has been a sector that has been beleaguered. It's also a sector that has been abused quite a lot, has been under stress. Would anything in the power sector stand out, and would Tata Power be that stock?
Afternoon, Sumera. If you look at the numbers that Tata Power has delivered in the quarter gone by, yes, I think the numbers were a little bit better than what the street had expected. But what stood out for the numbers and the profitability in general was obviously its Mundra and coal JV hedge. So I think the Mundra JV, specifically on the coal front, did benefit significantly. And because of that, I think the expectations of the overall growth numbers came through. Now, there is also certain elements of talk being undertaken that there is deleveraging that is expected to happen on the balance sheet. They have completed the sale of its energy business, almost $100 million if I'm not mistaken. The defense business sale is expected to happen over the next few quarters, and also the potential sale of its renewables and its shipping portfolio as well. So that is the need of the hour. Looking at the leverage on the balance sheet, which is clearly around 47,000, 48,000 crores. And though I think the free cash flow yield and the dividend yield has become extremely strong, what we've heard in terms of the disbursements that will come through, specifically from RECPEC, I think the receivable positions should start getting lower. So I think two aspects. One, the asset monetization on the debt deleveraging on the balance sheet, extremely critical. What happens in terms of the new regulations for the Indonesian coal mines concerning tax and royalty, I think those aspects need to be seen. And the Mundra PPA, I think the amendments there for this mega power plant, I think any development on this one on a positive side can have an effect. So I think it's a wait and watch mode. So I think I'll wait and watch on how these developments take place over the next few weeks, months.
Okay, the next query from Mrs. Sangeeta Raje, who writes to us from Ajmer. She says she's interested in buying some stocks from the hotel industry. Now, this is interesting because, at least in Maharashtra, hotels have got the nod to reopen. But this is an industry that has, faced a very, very tough time. And even going ahead with permission to reopen, the jury is out on how many people will actually be visiting hotels, restaurants, the drill. Mayuresh, what would you advise? Is hotel an industry that you'd recommend retail investors stay away from, at least for now?
Well, yes, Sumera, I think, and you're absolutely right. I think even though I think the norms have come through in terms of the hotel openings, how are they able to cope up in terms of their fixed cost element is extremely critical. Now, for the hotel industry as a whole, the occupancy levels are extremely critical because on that basis itself, do their entire revenue synergies get synced with the fixed cost that they incur as well. So with revenues expected to remain extremely volatile and fixed costs which are expected to remain extremely elevated for the hotel industry as a whole, I think the cash flows definitely come under a lot of pressure. The second element obviously is with the pandemic in terms of both domestic arrivals as well as foreign arrivals. I think more or less on an annualized basis with Q1 expected to be a washout and expected recovery only expected to happen in the second half, if any. You're expected to see the average room rentals actually come down quite significantly. The third element obviously is the other aspects associated with the business as well. So I think the MICE events or the food and beverages businesses, which again is a very high gross margin business, that comes under pressure because of lower footfalls. And the fourth important aspect then becomes the focus in terms of balance sheet dynamics, specifically from a debt perspective. So if I stack up the hotel companies in general, EIH has the least leveraged balance sheet as on date at this point of time. Indian hotels, yes, around 0.8, 0.9 times debt equity levels. But the capex plan that they had undergone, that can have some strain in terms of the operating cash flows. Taj GVK comfortably placed But again, I think the run-up to the stock has been quite significant, and Lemon Tree, I think, the most leveraged company within the dynamics of the industry itself. So I think it's a tough industry to be in, as you rightly said, Sumera. The cash flows are definitely going to take a hit on an annualized basis. So from a medium-term, long-term investing, I think just stay put at this point of time. No need to rush in as per our cancelled methodology as well. From a strategic short-term perspective, I think there might be opportunities, as I said, in terms of the stack up of the stocks considering the leverage. I think Rajat might be a better person from a short-term perspective.